Welcome to the Inside Track on Real Estate with Ken Decker and the Decker team. And today, actually, we don't have the whole Decker team or even part of the Decker team. We have Lynn Fraser, very special guest here. Lynn Fraser is a mortgage broker, and we're going to be talking about getting mortgage financing for your home, either the one you're in right now or the one you hope to buy. And so Lynn is an expert in that, and that's why we brought Lynn onto the show. And we're very excited to have you here, Lynn.
I'm happy to be here.
Excellent. Now, getting a mortgage for a house, right? Mm-hmm. A lot of people just go to the bank because the bank is where they go there to get their money out of the ATM, and not too many people actually go and see a teller anymore, but they're just kind of used to all their financial stuff is there at the bank. So what's the difference of going to a bank for a mortgage or going to a mortgage broker like yourself?
Well, typically what I find is that anytime you're talking to a banker, you're speaking with someone that is paid to make a profit for someone else. And as long as that profit's coming out of your pocket, they really can't give you the advice that's in your best interest. Does that make sense to you?
Yes.
So what a mortgage broker will do is provide you with guidance or counsel that is in your best interest. They don't work for any one financial institution. And in fact, the more that they save you, the more their business grows. So you're not in conflict.
Interesting.
Does that make sense?
Interesting concept. Yeah, so would it be like going to an insurance company, mm-hmm. and the insurance company only has their own product to sell, and it may work for your particular situation, but it also may not be the best for your particular situation, whereas an insurance broker, which many people are very used to going to, mm-hmm. has access to multiple insurance companies, and therefore can put a better product for your particular need and maybe a better price.
A very similar concept. If you have a good mortgage broker, they will spend time finding out what's truly in your best interest, not in the best interest of the financial institution, and then match your needs with the product, which is available through 35 different lenders. So once you have a really good idea of what the big picture is, where are you going? How long do you plan on staying in your home? Is this more for investment or a place to live? Which one's of higher priority to you? What kind of a risk taker are you? Do you like certainty? There's a number of questions that someone should be asking to get a good sense of what's important. Okay. And then that person can be matched with a product. Could be any one of 35 different lenders.
Okay. And so, Lynn, our listeners may decide, well, a mortgage broker may be able to help me, but what's that cost them? Because there's got to be a cost for your services.
There can be, but typically the fee for a mortgage broker is paid by the financial institution that the mortgage is placed with. And there really is no difference from one lender to the next, or very small difference. So there shouldn't be any biases between the lenders. Ideally, there are times where a mortgage broker fee may be charged, but those are cases where it's very complex and the client will know right up front.
So in that case, it's probably they're not going to be able to get the financing through their bank anyways, no. Because if you're having to charge, that means you can't get the mortgage funded through any one of the regular banking systems. Is that right?
That's correct. So It needs extra work, extra care, and so may charge a fee. Okay.
So Lynn, tell us a little bit about what you do, because you don't just introduce a client to a banking institution or a lending co-op or whatever, mm-hmm. wherever the money's coming from, an insurance company or whatever. What's the process right from the start? When should they come and see you, or when should they call you in the process of mm-hmm. buying a home mm-hmm. or refinancing? And take us through that process so we get an understanding of what you do for
sure.
the client.
I would say that I should be the first call before you call a real estate agent.
Okay.
If you call me first, you're going to get a very clear picture of what you can afford and what's going to make sense for your lifestyle. So once I receive a call from a client, then I'm going to sit down and spend an hour and a half or so with a couple to find out really what's truly important to them, rather than looking at what are you going to qualify for, right? Because those are all based on ratios. I want to spend some time understanding what kind of a lifestyle you want to lead. What is it going to cost you to live that lifestyle in a new home? And then we can determine what kind of a home and mortgage is going to fit into your budget. Most of us don't do a lot of budgeting these days. Most of my clients haven't done any budgeting before they come to see me. So I'm going to make sure we're going to spend some time doing that first.
Well, that's a really extra service. I've never heard of any of the lending institutions doing that kind of service for their clients.
No, it's unlikely that you'll find that in a financial institution. But I want to make sure that you're buying a home that fits within your lifestyle. And so you can, because you want to determine that you're going to live in this place. You don't want to buy a home and then find that you can't squeeze into it, so you get squeezed out of it.
Right. Yeah, I've been to homes where I've had to sell a home for someone that they borrowed the maximum they could possibly borrow, so they were actually house broke. And then they decided, I don't like my lifestyle anymore because all my money's going to mortgage payments. I can't buy nice furniture for my house. I can't go out for dinner every once in a while. And so they decided, well, we better get a smaller house, smaller payment. And that's an expensive process to change houses.
Sure it is.
As opposed to buy the right house to fit your lifestyle and your budget to start with.
A very beautiful home will pale very quickly if the budget's too tight.
Okay.
So once the budget is done and we have a sense of the lifestyle that you want to lead, then we can explore what are the options that are going to fit your family. So we're going to look at variable rate versus fixed rate. We're going to look at short-term versus long-term. We're going to determine based on what's happening in the market and what's expected in the economy, whether we should be looking at a 3-year or 5-year or 10-year. There's many different options that are available. In most cases, the right product really depends on the client. So there is no cookie cutter as to what's the best product.
Yeah, I said in one of my previous shows actually that prescription without diagnosis is malpractice, and I think it's probably the same in your business. There is no one product that's right for one client until you actually get to know them and know what their lifestyle is, their propensity for debt, their ability to handle the unknown, like a variable rate can fluctuate. Some people need to know that their payment's going to be the same for the next 5 years or 10 years. Yeah, so that's excellent.
And even exploring lines of credit. It's more common today to have a client come and say, well, I'd like to get a line of credit to buy my home with. Well, that was a concept that was introduced by the banks more heavily over the last 5 years because the banks make more money. And so it's not, a line of credit is, there are places for it, but it's not, it doesn't fit as many people as people would think they would.
Okay, so a line of credit as a mortgage product would be more for someone that has, I would say, large income fluctuations and may want to pay down chunks of it, or they're expecting an inheritance, or they don't want penalties, or they're the type of person that invests and they have investments that are coming due that will come in and then they need to buy other ones, so it gives them that flexibility. But for the most part, people in a regular 9-to-5 job that are earning the same amount of money typically per week, a fixed amount or a mortgage, not a revolving like a line of credit, but that type of mortgage is more suited to them because they're going to have that debt for a long period of time.
Agree.
Okay, excellent. So now we hear about pre-qualification and pre-approved, and dispel some of the myths around that. And what's the difference?
Most common is a pre-approval. So most people will call me and say, okay, I want a pre-approval. What that means is a rate hold. So financial institutions will typically give you a pre-approval based on the information that you tell them, such as how much do you earn, how much do you have down, and they will hold a rate for you. But very rarely is pre-approval fully qualified. And what I mean by that is it's not uncommon for someone to have a pre-approval thinking that they can go ahead and buy their home, only to find out once they've found the home that they've fallen in love with that they really don't qualify after all.
Oh, why would that be?
Because there was no homework done up front. Generally speaking, financial institutions don't want to go through the work of doing a full pre-qualification because it takes more time, and most of their clients don't come back. Only about 30% of the clients that get a pre-approval will actually go back to the institution that they've got their pre-approval with. So they don't spend a lot of upfront time.
Okay, so pre-qualification, you're actually doing 70-80% of the work that
That's right.
you'd be doing to actually close a mortgage on a property that someone's purchasing.
That's right.
Would that be right?
That's correct. So when someone comes in to meet with me for their first meeting, I'm going to ask them in advance to bring in their letters of employment, pay stubs, the types of documents that they're going to need to be fully qualified. So when they leave my office, they know in advance what they're going to qualify for. There's no second guessing. They know in advance that, yes, in fact, you're going to have no issues. When you find your property, you can count on it closing.
So you do a credit bureau check to make sure there's nothing in the closet, no skeletons in the closet that they forgot about or purposely forgot to tell you. Okay, so as far as I'm concerned, as a realtor, a pre-qualified client is a real gem, because in a market where there sometimes are multiple offers on properties in desirable areas, or we need to buy a house quickly because that house is going to sell rapidly and we want to beat other people. If we know that a person is pre-qualified, that means you've done all your homework, they've done all their homework getting you letters of employment and different things, and we can go in with a much stronger offer, still conditional on the house being approved for them for that value, but we can go in and say we have a pre-qualification, and that may put us ahead of other buyers who haven't even started down the process yet.
Sure. And it eliminates a lot of heartache. There's nothing worse than a client, as you know, that you've spent days and days and hours with searching for just the perfect home, only to have them find that home and then be disappointed when the financing doesn't go through.
Yes. Yeah. And sometimes we can even buy a house for less money when the seller knows for sure that the buyer can actually close on it and get the money. So that's really good. What about first-time buyers? They're very inexperienced about getting a mortgage. They have to get some down payment from somewhere. And are there any programs to help them? And also, what kind of down payments do they need?
Typically, 5% down. There are products out there that offer 100% financing. They have some special clauses within them, but typically 5% down is the minimum. Home buyer plans will allow someone that's a first-time buyer to take money out of their RSPs to be used for the down payment. So an individual can take up to $25,000 out of their RSPs to use as a down payment on a home. If they're a couple, that's $25,000 each for $50,000.
So $50,000 is a good down payment.
It is.
Now, actually, it was realtors that lobbied for that program. I don't know if you knew that.
I didn't know that.
Yeah, our
Way to
political
go.
activation committees lobbied for the RRSP program to come into existence, because it really didn't cost the government much, but it made first-time home purchasing a more feasible thing.
Sure.
And they have to pay back the RRSP money that they took out. It's their money, so they don't pay loan payments or anything on it, but they have 15 years. So they divide whatever amount they took out by 15, and they have to put that amount in each year. So it's a good program. And the money has to be in the RSP for a certain amount of time.
Has to be there for 90 days
90
before
days.
it can be removed as part of the first-time home buyer's package.
Okay. So someone could actually put money into an RSP in this year. After 90 days, buy a house or close on a house. They can actually buy it before, but they can't close on it because they can't take the money out, right?
Correct.
And then in April, they can get a nice tax refund because they put all this money into their RSP and then took it out if they have RSP contribution room.
That's true.
Yeah.
A lot of times as people are preparing for the spring market, because that's when most people, when the majority of people are planning on buying their home, right? Generally early in the year or the first 6 months of the year. So you could put your money in your RSPs before the end of February, leave it there for 90 days, and then take it out and get a nice tax return, which will help with your closing costs.
Closing costs or new appliances or whatever someone may need, yeah. Now, there's an interesting product that we call it Purchase Plus Improvements. And I'd love for you to talk about that a little bit, because sometimes a buyer can find a much better price on a property that needs some work, but they don't have the extra money because they're using up all their cash reserves for the down payment, right? And they don't have enough money to do the renovations. Maybe it needs shingles on the roof, or maybe it needs a new furnace, and the deck's rotting on the back, and that sort of stuff. So there's a product called Purchase Plus Improvements.
I think that is probably one of the most underutilized products out there. Because if you have a realtor that can visualize or can help paint a picture of what this home could look like, you can actually save a lot of money in purchasing a home that others haven't seen the value in because it needs some work. So you can buy a home that others have passed by, not having the foresight or the vision to see how wonderful it could look. And then with the Purchase Plus, you would have someone come in and give you a quote on what the work is that needs to be done, what it's going to cost, and actually have that added to the purchase price of the home and have the repairs or renovations included in the mortgage. So, for example, if you were buying a home that was worth $250,000 and it needed $30,000 in renovations to whatever part, whether it's flooring and windows and doors, you would get a quote on that $30,000 worth of renovations. Then the lender looks at the property as if it's worth $280,000, and your mortgage is based on that. So you actually will get the money for your renovations before you.
So when I show a home that's in a great neighborhood and it's in great condition, but maybe it's got a pink or a green tub and sink, and the kitchen's from 1965, and they'd like granite and dark cupboards, they could put that in with the Purchase Plus Improvement and be in the neighborhood that they want to be in, because that home, once it's renovated, may be worth significantly more than even the money they put into it.
Exactly.
Yeah, that's very exciting.
And they don't have to figure out how to finance it after they've moved in, which can be a real problem.
Right, because it's all done in advance, and once the work's done, the lender forwards more money. Is that correct?
That's right. And it is in the value of your home. So mortgages are extended over a longer period of times than most loans are, and it will cost you less money in the long run.
Excellent. That's a great program.
I like it.
Now, we hear this talk about mortgage insurance. Does mortgage insurance protect our buyers for, if they lose their job or they can't pay or something like that? Or who does mortgage insurance really protect?
Well, there's two different types of mortgage insurance. There's mortgage default insurance, which is more commonly called CMHC premiums or CMHC fees. And then there's mortgage life insurance and disability insurance. So two totally different products. So frequently when people are talking about mortgage insurance, what they're talking about is mortgage default insurance. And that policy is to protect the banks. In Canada, our banking system is very strong, and thank goodness. And the banks cannot lend out more than 80% of the value of a home without it being insured, which means that the buyer has to put down 20% down payment. Or they can put down 5 or 10 or 15% and pay a CMHC or a mortgage default insurance premium, which protects the banks. So if they default, if they don't make the payments on their mortgage on time, and the bank has to take back their house to recover their money or the bank's money, then the CMHC insurance will kick in and protect the bank, make sure they get all the money back.
So it protects the bank for the difference. It doesn't protect the homeowner who lost their job or whatever. No, it doesn't protect them at all.
No, but it's a funny thing because it's not the bank that pays for it. It's the homeowner that pays for it.
Interesting. Now, what about this life insurance? You mentioned life insurance, disability insurance for our mortgage payment. Is that a good deal?
No. The only one that benefits is the people that sell it. So typically, whether you're dealing with a bank or a mortgage broker, they will offer a mortgage insurance, life insurance and disability insurance. And so the bank or the mortgage broker will earn a commission for selling it to you. But generally speaking, it's not good coverage. One of the concerns that I have with it, first of all, there is no health checkup done. If you were buying life insurance from a life insurance agent, they would do some kind of a health checkup on you. But if you're buying it from a mortgage company, they don't do any of those health checks. So what they do when it comes time to realize on the insurance, right, if someone has died and you're putting in a claim, then they're going to look through the history and see if they can find a way to decline it. So you may have paid insurance premiums for years and years and years and never really qualified and not known it. Secondly, when if you have insurance on a $200,000 mortgage, over time that balance is going to decrease, but your premium hasn't. So if you've paid down your mortgage to $130,000, you only have coverage now for $130,000, whatever the balance is on your mortgage, but your premiums have not decreased with your insurance policy. So it's not a good coverage.
It's very expensive.
I mean, there can be places that it does make sense, but that's back to your previous statement. You want a diagnosis before you actually give a prescription.
Right. Now, I've heard some people tell me, actually, interesting you mentioned that they may disqualify you, but if you can't qualify for regular term insurance or life insurance, that it's a good idea to get the mortgage insurance because they don't do the medical check.
That's true, but you have to do that understanding that it's only going to cover some things, such as if you were in a car accident and you died, then it may pay out because it had nothing to do, as long as it wasn't related to any pre-existing illnesses, it might pay out.
So if you had a heart ailment or cancer or something and you got that insurance and then you died from the cancer, they would say, no, you disqualified yourself because you should have informed us that you had you had that illness.
It doesn't cover for any pre-existing conditions.
Interesting. Okay. So we've talked about a few interesting things. Is interest rate, you always hear about interest rate. Is that the most important thing?
No, it is an important piece. But generally speaking, the interest rates are basically the same from lender to lender. There isn't a wide discrepancy from one lender to the next on the interest rates. It's really just marketing. Right, when you're seeing one rate advertised here and a different rate advertised somewhere else, this first lender is probably going to bring the rate down to this anyway. You just have to play the game of going back and forth to get the right rate. That's where that's part of a mortgage broker's job, is that we know what the best rates are up front and who's offering the best today, so you don't have to do that song and dance to get it.
Right.
But there's a lot of other things to take into consideration, such as amortization, prepayment options, actually exercising on the prepayment options. For example, if I have a client that if the timing is right for a variable rate mortgage, I will always preset the client's payments as if it's on a fixed rate so that they're really accelerating the pay down on their mortgage.
Okay.
But those are things that you won't know unless someone guides you through that process.
Right.
So interest rates are part of the puzzle, but they're just a piece of it.
And we've experienced very low interest rates for a very long time, haven't we, Lynn? And it's interesting because interest rates have been going down for, I don't know how long have interest rates been going down, roughly. I mean, they've had some very little fluctuations up and down, but we haven't really seen a climb in interest rates, a significant climb in 10, 15 years, 20 years?
Oh, at least, yeah.
Yeah. So a lot of people with variable rates have won as the rates go down. But variable rate came out to protect the bank, because when interest rates go up, their rate goes up. So they're not stuck with long-term low interest rate mortgages, right? So now that we've been there so long, if rates go up, then the people that, if they go up significantly, the people with variable rates could not be in as good a product. So it's really important, like you said, to analyze and figure out exactly which product is best for your situation.
It's not difficult to do the math. What I'm suggesting to my clients now is more fixed rates and not variable rates. Those that are currently in a variable rate mortgage, what I'm suggesting is do an analysis and determine and set your payments now as if you were on a fixed rate, so that you're taking advantage of the low rates when you've got them, and you're also preventing what we call payment shock.
Right.
Which is what happens, which is what's going to happen when the interest rates go up. Because I've got clients now whose payments could double.
Yes, because we thought, usually the thought is that 1% is not very much, or 2% is not very much. But when you're only paying in a variable rate 2.5 or something, and it goes up 1 or 2%, you've doubled your payment.
Yeah.
And I'm not sure people are ready for that. So I could talk to you all day. This is fantastic, Lynn. And yet, we have a radio program and we're limited to a specific amount of time, so we're just coming to the end of our time together. And what I'd like you to do is just give our listeners, how can they reach you? How can they get in contact with you so that they can get your expertise?
Sure. If you have any questions about your mortgage on your existing home, or you want to explore the options for the future, give me a call at 613-520-4157.
What was that number again? I missed that.
Okay, 613-520-4157.
That's excellent. And you've been listening to the Inside Track on Real Estate with the Decker team. And I'm Ken Decker, and I'm a broker of record of Keller Williams Solid Rock Realty. And we'd love to hear from you. You can email us ideas or questions that you would like information on. You can do that at deckerteam@chri.ca, or you can call me directly, 613-860-4663. And we look forward to helping you find your next home.